Hello and welcome back to my YouTube channel. This video is my last one in a series on credit derivatives. In my other videos on the topic, I've mostly just explained what the various credit derivatives are, how they are structured and are priced. In today's video, we'll try to learn about the credit crisis of 2007-2008, how these credit derivatives played into it, and what lessons have been learned, and how markets have changed since then. So firstly, what was the financial crisis of 2007-2008? The global financial crisis was the biggest jolt to the global financial system in almost a century, which pushed the world's banking system towards the edge of collapse. It could be argued that the crisis began in August 2007. In August 2007, American Home Mortgage, one of the largest American home loan providers, filed for bankruptcy. BNP Paribas suspended 3 of its investment funds with over $2 billion in assets under management, citing problems in the US subprime mortgage sector. Countrywide Financial drew down its entire $11.5 billion credit line, and Northern Rock, the largest British mortgage banker, experienced an old-fashioned bank run for the first time in Britain for 100 years. So let's firstly talk about what caused the financial crisis. The 2007-2008 financial crisis was building for a long time, and its causes were varied and somewhat controversial. Different people like to point the finger of blame at different groups. Some want to blame banks and financial market participants. Others want to blame people for borrowing too much money and for lying on their mortgage application forms and for general financial irresponsibility. In this video, I will try to explain some of the background of the global financial crisis with a focus on credit derivatives, mainly because the main focus of this YouTube channel is quantitative finance and financial derivatives. Many of you have probably finished watching my series on credit derivatives, and in order to understand these products properly, it's important to consider their role in the global financial crisis. Let's start with a discussion on the lead-up to the credit crunch. The dot-com boom in the late 1990s was followed by the dot-com crash in the early 2000s. The Federal Reserve slashed interest rates from 6.5% to 3.5% in order to stimulate the economy. Then in 2001, the September 11th attacks took place, and interest rates were cut all the way down to 1%, the lowest rate for 50 years. For 31 consecutive months, the base inflation-adjusted short-term interest rate was negative. The years 2000, 2001, and 2002 were all down years in the S&P 500, and it was only towards the end of 2003 that markets turned around. Investors were at that point fearful of stock investments, and because of the low interest rate environment, unhappy with the returns they could expect in fixed income markets. Many institutional investors rushed to invest in CDOs and other innovative financial products that promised high returns with low risk. Many of those investors put their money in these products and didn't really understand what they were and how they worked, but trusted the credit ratings agencies to assess their risk. The cheap money brought about a housing bubble, an explosion of leveraged buyouts, and other excesses. Easy availability of credit in the United States, fueled by low interest rates and reduced credit monitoring by financial institutions, led to a housing boom which facilitated debt-financed customer spending. The existence of credit derivatives and securitization allowed financial institutions to make larger volumes of riskier loans than had been made in the past, and consumers assumed an unprecedented debt load. Mortgage lenders at the time thought they were taking very little risk because the value of the collateral underlying their loans was rising very fast, and that was just because house prices were going up. A study published in 2007 showed that there was a relaxation of the criteria used for mortgage lending. The research defines high denial zip codes as zip codes, which is an American term for postal codes, where a high proportion of mortgage applicants had been turned down in 1996. They showed that mortgage origination grew particularly fast for these zip codes from 2000 through to 2007. These results suggest that lending criteria were relaxed progressively through time rather than all at once, because originations in high denial zip codes are an increasing function of time during the 2000 to 2007 period. Between 1998 and 2006, the price of the typical American house increased by 124%. Between 1981 and 2001, the national median home price was in the range of 2.9 to 3.1 times median household income. This rose to 4.6 times median household income in 2006. In the early 2000s, there was borrowing on a huge scale to finance what many property investors believed was a sure thing bet on rising property prices. Many of these investors thought that the stock market was too risky and the bond market too low return. In the property market, they were able to assume huge leverage from banks who were not concerned with the risk of the loans that they were making, because they were not required to keep them on their books. Once the housing bubble had been started, mortgage lenders wanted to keep it going by attracting new entrants to the market. Because house prices were going up, they had to become creative in finding ways to make houses appear affordable, especially as there had been no real growth in real median income in the 2000s. One approach was to offer an initial period of 2 or 3 years where rates were below market. In a 228 adjustable rate mortgage, the rate might be fixed at below market rate for the first 2 years and then set equal to 6-month LIBOR plus 6% for the remaining 28 years. The typical subprime borrower at the time, with a credit score between 450 and 680, could obtain a loan with little or no down payment, provide little or no documented proof of income or assets, and obtain a loan with a low initial teaser interest rate that reset to a new higher rate after 2 or 3 years. Historically, banks would have been unwilling to make loans like this, but because of the huge demand for mortgage-backed securities like CDOs, which I've explained in an earlier video, the banks were able to make this type of loan and quickly package the loans and sell them on to investors. The property boom was ultimately unsustainable because from around 2005, the gap between people's incomes and debt began to widen. When home prices declined in the latter half of 2007 and the secondary mortgage market collapsed, a global financial crisis was triggered. Credit derivatives were blamed by many for bringing about this crisis or for intensifying it. Credit ratings agencies are widely believed to have failed the markets in their calculations of credit risks on credit derivative products in the lead up to the financial crisis of 2007-2008. They relied on models that were given to them by the credit derivative issuers. The fact that they are paid by the security issuer rather than by the buyer of the security brought their impartiality into question. There is just a structural conflict in the fixed income markets, whereby investors are the beneficiaries or ultimate end users of credit rating calculations, yet the party paying for the ratings themselves is the issuer. Rating agencies are of course incentivized to give these products good ratings, because should they not do so, the issuers would be unlikely to give them any valuable repeat business. On the back of the financial crisis, politicians and regulators globally are pressuring originators to resume the former practice of maintaining at least some of the credit risks on the instruments that they originate on their own balance sheets. Politicians face a trade-off of hoping to incentivize high consumer spending and home ownership rates to boost GDP and to achieve social goals associated with home ownership, while seeking to avoid the negative outcomes from widespread over-indebtedness, from lax credit standards, and real estate bubbles. Stronger credit controls stabilize an economy, but reduce home values, decrease home ownership levels, and reduce an economy's GDP growth. The crash first struck the banking and financial system of the United States, with spillovers into Europe, where another crisis, one of sovereign debt, arose from the flawed design of the Eurozone. This allowed countries such as Greece to borrow on similar terms to Germany in the confidence that the Eurozone would bail out the debtors. When the crisis hit, the European Central Bank refused to reschedule or mutualize debt, and instead offered a rescue package on the condition that the stricken nations pursued policies of austerity. So let's next discuss whether many people saw the credit crisis coming. A number of investors and economists do claim to have predicted or anticipated the 2008 crisis. But at the time, there was a complacent assumption that crises were a thing of the past, and that we were in a period of great moderation. The idea that over the previous 20 or so years, macroeconomic volatility had declined. The variability in inflation and output had declined to half of the level of the 1980s, so that the economic uncertainty of households and firms was reduced, and employment was more stable. In the years leading up to the credit crunch, there was record low volatility in the stock market. In 2004, Ben Bernanke, then a governor of the Federal Reserve, who later served as chairman from 2006 to 2014, was confident that a number of structural changes had increased economies' ability to absorb shocks, and also that macroeconomic policy, above all monetary policy, was much better in controlling inflation. Some investors did foresee the problems that would come from the housing boom, many of whom were profiled in the Michael Lewis book, The Big Short. I'll put a link to that book in the description below. That book was later turned into a film. George Soros wrote a near real-time critique of the credit crisis called The Credit Crisis of 2008 and What It Means, a book he rushed to print in the middle of the crisis, explaining his view of what was happening and how he thought it would resolve. I'd strongly recommend that book once again, and I've put a link to it in the description below. In the book, Soros describes the two-way link between the creditworthiness of borrowers and banks' willingness to lend. In most loans, collateral is involved, and the most basic form of collateral in the world is real estate. Bubbles, he explains, arise when banks treat the value of the real estate as if it was independent of the bank's willingness to lend against it. This self-reinforcing cycle drives real estate values up to begin with, but once the trend reverses, the exact opposite happens. And this is all tied into that George Soros idea of reflexivity, and I might even, at some point in the future, if I have time, put up a video trying to explain that topic. There are many investors and TV commentators who claim to have warned of the credit crunch. It's difficult to assess how truthful some of them are being. Some of them have been predicting disasters for their whole careers, and like a broken clock, they were right on that occasion. Many who claimed to have predicted the crisis argued that the market would collapse further, and then went on to be wrong for the next 10 years as markets rallied. So let's quickly discuss how some of the credit derivatives I went through in my prior videos related to the financial crisis. We'll start with securitization. Financial institutions frequently did not retain the mortgages they originated on their books. Subprime mortgages were securitized and sold to investors using asset-backed securities, or ABS. I've linked to my video explaining asset-backed securities above. Securitization has been an important and useful tool in financial markets for many years, but it played a part in the creation of the housing bubble. There was a clear link between securitization and the lax screening of mortgages. If you've watched my video on CDOs, linked to above, you can see how CDOs were structured, allowing a bank to take a portfolio of bonds of average quality and create some AAA rated bonds, along with some mid-rated bonds and some really low quality bonds. The really low quality bonds were often unsellable, and so retained by the issuer of the CDO. There is a huge unsatisfied demand for AAA rated securities, as bond investors in general are most attracted to the safest investments. Up until mid-2007, there was no difficulty in finding investors to buy the AAA tranche of a CDO. The mid-rated bonds were often not so easy to sell. This is where financial engineers became creative. They designed a structure known as a CDO squared. This tranches out the risks from a portfolio of mezzanine tranches in the same way that a CDO tranches out the risks from a portfolio of subprime mortgages when the original CDO is created. These too created some AAA bonds, but ones that were obviously significantly riskier than the first round of AAA bonds that were created. While the first bonds would still receive the promised return on the structure if losses on the underlying mortgage portfolio was less than about 25%, the AAA rated tranche of the CDO squared would not be as lucky. It would get paid the promised return only if losses on the underlying portfolios are less than about 10%. Nonetheless, both were AAA rated by the credit rating agencies. The role of credit default swaps, or CDS, in the financial crisis has been debated among regulators, market participants, and academics since early 2008. CDS are derivative instruments which enable market participants to transfer or redistribute credit risk. Click the link above to see my video on CDS. It's argued that the size of the CDS market, combined with its structural opacity, concentration, and interconnectedness, may be a sign that the CDS market also poses a systematic risk to financial market stability. The credit default swap market has grown much faster than other derivatives markets since its inception. Even though it is dwarfed by the interest rate derivatives market, which is 8 times larger, its growth has affected the stability of the financial system. CDS were originally designed as a risk transfer tool to allow investors to hedge their position in the debt of a reference entity. But much of the activity in this market is speculative. Credit default swaps have been blamed for financial instability and generating systematic risk. Much of the blame has to do with the supposed role of speculative credit default swaps in pushing up CDS spreads of entities in distress, thus making it harder for them to access the debt markets. Politicians have been quoted as blaming CDS markets as being responsible for the deterioration of their sovereign debt, the most notable example being Greece. No empirical evidence has been put forth, however, to back up these claims. According to figures from the Depository Trust and Clearing Corporation, CDS positions on Greece amounted to $9.2 billion in March 2010, up from $7.4 billion in 2009, which is less than 2.5% of the Greek government bond market, which exceeds $400 billion US. One might argue that it is a case of informational contagion, where CDS markets generate a panic in the debt market. In fact, in the case of Greece, CDS spreads closely tracked bond spreads in 2010, showing no evidence of one leading the other in a significant way. Finally, there is no evidence that the May 2010 ban on what they call naked CDS positions had any stabilizing effect on the sovereign debt market. Not to be a CDS apologist, though, there are many flaws in the design of CDS that I've discussed in my book and in my classes. One flaw is that CDS are generally traded as 5-year contracts, and there is very little liquidity in what are known as off-the-run CDS contracts. Traders might buy a CDS contract and after a few weeks or months wish to sell it. They might do this by entering into a new offsetting 5-year contract, which mostly hedges their exposure, but will leave some non-overlapping risk when the first contract rolls off and the other contract still has some time left on it. Regulations passed in recent years seek to reduce this problem, but it could be argued that this is a fundamental design flaw of these contracts. One of the first signs of the problems caused by CDS in markets was when Bear Stearns failed in 2008. A trader betting on the failure of Bear Stearns using a simple derivative like a put option would have profited. The Fed's bailout of Bear Stearns in 2008 was motivated in part by a desire to prevent the banks who had written CDS on Bear Stearns from defaulting, says Joseph Mason, a former US Treasury Department economist who is now chair of the banking department at Louisiana State University. He argues that the Fed was concerned that banks might not have the money to pay CDS counterparties if there were large debt defaults. The Fed was worried about the biggest players in the CDS market, Mason says. It was a JP Morgan bailout, not a bailout of Bear. Others argue that the thing that the Fed was worried about was the CDS written by Bear Stearns. If Bear were to go bust, then no one would have a clue how to value all of the credit protection that Bear had written. Whatever the politics of the situation, that event highlighted that it might be pointless buying CDS protection on a firm deemed too big to fail, as you might just be paying insurance against an event that the government might never allow to happen. Another flaw in CDS that many have pointed out is that neither the buyer nor the seller of CDS protection needs to have a position in the debt of the underlying reference entity. Some have likened this to allowing people to buy fire insurance on their neighbour's home. In 2018, the case of Hovnanian and Blackstone Group's GSO Capital Partners highlighted this issue. GSO agreed in 2017 to lend money to Hovnanian. As part of that deal, Hovnanian agreed to default on a chunk of its debt, a step that allowed GSO to profit from a separate credit derivatives trade. GSO's gains from credit derivatives allowed it to offer the builder relatively cheap financing. These kinds of transactions aren't new, but have been drawing greater attention of late. Many market participants view the deals as market manipulation. In fact, in the UK, it's hard to argue that it wouldn't be considered market abuse. The Commodity Futures Trading Commission, or CFTC, said last year that they are looking at whether these kinds of deals amount to market manipulation or not. This type of transaction doesn't always involve a manufactured default either. A hedge fund named Chatham Asset Management lent to newspaper chain McClatchy Company in a way that market participants believe was designed to give a big payout to derivatives traders, betting that the parent company would keep paying its obligations. So as you can see, these things can work in either direction. Now, while it's easy to appear wise after the event, let's review some lessons that can be learned from the crisis. The interests of loan originators were not aligned with the interests of investors. Loan originators did not ask the question, is this a good lending opportunity? Will the borrower make payments as promised? Instead, the question was, can I make a profit by selling this loan on to someone else? In some cases, the mortgage originator kept the equity tranche. This might look like it provides some alignment of interests, but when the equity tranche is worth zero to begin with, the originator does not actually have any real financial interest in the portfolio. They might be happy if that tranche happened to give them a positive return, but they're not really troubled if it turns out to be actually worth nothing, because essentially the reason they didn't sell it on to someone else was that no one would really pay them for this. If the securitization market is to have a rebirth, some changes are likely to be necessary to give investors confidence. One idea is that the originator should keep a certain percentage, say 20%, of all tranches. Regardless of what happens, the interests of originators are then aligned with the interests of investors. It's worth noting that there is a big difference between an originating institution securitizing 80% of its portfolio and an originating institution securitizing 100% of its portfolio while keeping 20% of each tranche. In the first case, there will always be a suspicion that the better loans have been retained by the originator and that screening was lax on the rest. Also, the originator has less incentive to be an effective administrator of the securitized portfolio in the first case. Ratings agencies might reasonably assign a higher rating to tranches of a portfolio where a percentage of each tranche has been retained. Normally, financial institutions do not trade instruments unless they have satisfactory models for valuing them. Typically, there's a group within a financial institution that has the responsibility of vetting the model used for valuing a product, and the product cannot be traded in any real volume until the model has been approved. What is surprising about the subprime crisis is that financial institutions were prepared to trade senior tranches of an ABS or an ABS CDO without a model. Possibly it was thought that a model is unnecessary for valuing a AAA rated instrument, but the lack of a model makes risk management almost impossible and causes problems when the instrument ceases to be rated. The willingness of financial institutions to trade CDO squared is particularly surprising. CDO squareds are recognized by traders in the synthetic CDO market as highly risky products that are difficult to price. The market for them disappeared largely for this reason. These were nevertheless considered by many financial institutions to be a good investment. Because models were not developed, the key role of correlation in valuing these products was not well understood. The credit crunch was the most remarkable period that many investors may ever experience. It reshaped the financial landscape, threatened the stability of international finance, and changed Wall Street forever. If investors use the unprecedented events of the credit crisis to develop a solid understanding of good investment and risk management principles, they may one day look back on this difficult period and recognize that it served as the foundation for their future successes. Financial derivatives are, in my opinion, the most interesting and exciting area of finance. New products are constantly being invented, and most of the time they offer investors and hedgers new and better ways to conduct their businesses. It is important, though, for market participants to pay attention to market history and to learn from mistakes made in the past so that we can adapt and design our financial systems better in the future. I've tried to explain a lot of these complex issues as best as I can, but I'm sure there's lots that I've either overlooked or missed out on. Let me know in the comments section below your thoughts on financial derivatives and their role in the financial crisis, and what lessons you have learned. Hopefully you found some of the ideas in this video useful. That's all for today. Please hit the like button below and hit the subscribe button to see more content like this in your YouTube feed. Have a great day. Bye.